Welcome to the 9-point Concentrated Canadian Equity January 2019 update. I am Rob Dionne, a founding partner of Sheer Roulette, known as SRA, and portfolio manager for the Concentrated Canadian Equity Fund mandate. On slide 1, today I'm going to provide you with a quick overview of Sheer Roulette, a review of the SRA Concentrated Canadian Equity Fund performance in 2018, and year-end positioning going into 2019. Starting with a very brief description about SRA's investment process on slide 2. SRA is the Canadian equity value manager within the Connor, Clark & Lunn Financial Group, Canada's largest independently owned money manager. Our philosophy is that businesses that are good at what they do deserve a reasonable return on capital provided their good or service is valued by the marketplace. We invest with fundamentally driven bottom-up value approach. In terms of investment process, we start with a screen for stocks on PE, price to cash flow, price to book value to identify potential value opportunities. We do detailed research on a company and industry to assess whether a potentially discounted valuation is reasonable given the risk level of a company. If an opportunity, we analyze the competitive environment and forecast cash flows and earnings to determine profit sustainability. We use either discounted cash flow or replacement value to determine fair value. And using these valuations, we construct a well-diversified portfolio of around 40 securities. Turning to slide 3. To arrive at the SRA Concentrated Canadian Equity Portfolio, we select approximately 20 of the best opportunities from the SRA Canadian Equity 40 stock portfolio, which is led by my partner and colleague of over 22 years, Lloyd Roulette. First, we exclude positions that don't meet a minimum return threshold relative to our fair values. We increase weights of securities with the greatest upside potential, so we essentially remove some fairly valued diversifiers to have a greater concentration of our best opportunities, resulting in higher return expectations, albeit with more volatility. We apply minimum and maximum criteria to each name, a minimum 3%, maximum 10%, and a maximum sector of 50%. So all positions are meaningful within certain risk parameters. We continuously optimize the active positions relative to upside potential and overall portfolio weighted upside potential to arrive at a high quality, undervalued portfolio of approximately 20 names. We have some strict sell disciplines based primarily on the upside potential to our valuations. Price has appreciated, hence less upside potential. There's a change in fundamental outlook, our valuation could be reduced. Or if there's a more attractive opportunity that may emerge, because we're trying to optimize return relative to risk. Slide 4. Next, some highlights of the market returns for 2018 and a review of portfolio results. On slide 5, we focus our effort on company modeling rather than economic forecasting. But of course, some of these macro factors do influence forecasting assumptions. That being said, in general, investors continue to see an extension of multi-year improvements in the macroeconomic environment, as illustrated by a few select charts shown on slide 5. However, on slide 6, as the year progressed, fears started to creep in about growth as U.S. Fed raised interest rates, Eurozone tightened money supply, trade tariffs between the U.S. and its global partners slowed global growth, and numerous regional political drama added to the uncertainty. All of these factors combined took markets lower in Q4, such that performance of global markets ranged from slightly positive for U.S. technology to quite negative for China in Canadian dollars. Short-term fears of what might happen rather than what is happening seems to be driving sentiment. This emotionally driven sentiment has pulled valuations down and created opportunities that excite us. Turning to slide 7. The SRA Concentrated Value Strategy commenced on June 27, 2017, and had a great 6 months, as the strategy outperformed the market by over 10%, generating a return of 18% versus 7.7% for the index. Unfortunately, in 2018, the strategy underperformed by 8%, as the strategy fell 16.9% versus the total return of the market, minus 8.9%. Since inception, due to compounding, the absolute return of the fund has been minus 1.3%, which is flat versus the index. With a target added value of 4% plus per annum, we are expecting a better 2019. In 2018, weak security selection, primarily in materials and energy, and to a lesser extent in financials and industrials, drove the underperformance. Slide 8. Addressing the security selection attribution, let's highlight what worked and especially what didn't work. In materials, nickel producer Sherritt International fell 74%, and drilling company Major Drilling fell 35%. Major Drilling is a global drilling leader with no debt and a variable cost structure. When spending picks up, Major Drilling is well positioned to benefit. As for Sherritt, if battery demand for electric vehicles is half what people expect, nickel and cobalt prices should rise. And if so, Sherritt could be a triple, just back to where it started in 2018. There's debt on the books, but it's ridiculously cheap. D2, our only gold holding, was purchased at a low price and has benefited the portfolio. In energy, the entire sector was weak, but two holdings really disappointed. Crescent Point Energy fell 55% as commodity prices fell, while the company attempts to restructure to improve returns. Trican dropped a shocking 71%, as market conditions are much weaker than expected. Investors are not seeing through this period of weakness, despite the stock trading at sizable discount to replacement and has minimal debt, especially compared to competitors. We believe both securities are grossly discounted and are well positioned to more than double from low expectations when the energy sector recovers. Not nearly enough to offset, we did have some relative energy sector outperformers in Trinidad Drilling, Cameco, and Cenovus. Of these three, only Cenovus is still held with 40 to 50% upside potential. In financials, CI Financial fell 39%, which prompted them to cut their dividend in favor of buybacks, in response to its stock trading down to 7 times PE. We agree with management that the current trading multiple is too low. The portfolio benefited from a recovery in overly discounted Element Fleet Management as new management took over to turn business around. And finally, our only industrial sector holding, WestJet, fell 30% as the company never fully recouped profitability expectations from strike threats back in the spring. The company may have to endure some temporary margin compression, but the stock seems to be pricing in permanent margin compression, which we don't believe will happen. Slide 9. In all cases, the new positions that we put in the portfolio offered good upside potential, and the exit positions reached our valuation expectation. So as the market volatility provided opportunities, there was a fair amount of activity in the portfolio throughout the year. In energy, we sold TransCanada Pipeline, Enbridge, Trinidad Drilling after being acquired by Ensign, and Cameco. We added to some existing positions throughout the year as prices fell, and we also bought high-quality energy companies Suncor and Canadian Natural Resources towards the end of the year at low prices. In consumer discretionary, we bought Uniselect, a company involved in the automotive servicing business in Canada, the US, and the UK. And it's going through some restructuring as they recently hired JP Morgan to look at strategic alternatives. We feel this represents an attractive return relative to risk. In financials, we sold Bank of Montreal and specialty finance company ECN Capital and bought Manulife and added to a few of our existing positions in the banks, while both selling and then buying back Element Fleet Management 15% lower just a month later. In utilities, we sold our position in TransAlta as it hit our exit price. And in materials, we added Methanex, which declined from over $100 to $70 level, Tech, that has declined to mid-20s and has strong upside potential in copper, met coal, and zinc. Lundin for upside from copper along with strong cash position, and Detour, which was discussed earlier. Slide 10. Next is an outlook of how the company, or how the portfolio is positioned for 2019. Slide 11. Market cycles mean that investment styles come in and out of favor over time. For example, at times, large cap stocks can dominate market returns, while at other times, small cap stocks take the lead. The competing style to value investing is a growth approach. While growth style investing has been ahead of value on a rolling 5-year basis, most recently over shorter term periods, the leadership appears to be changing. In particular, the valuation gap between growth and value styles from a global perspective is the largest for over a decade. Will this change anytime soon? It's hard to tell, but we have not typically seen the growth cycle outperform for more than 8 years. And so far in this cycle, we are into our 9th year. Slide 12. The SRA concentrated Canadian equity portfolio characteristics are consistent with our bottom-up value approach, as forward PE of roughly 10 times is 20% below the market multiple. Price to cash flow multiples of around 6.5 times is a 30% discount, and price to book value at 1.1 times is at a 40% discount to the market multiple. In our opinion, we can achieve this discount without compromising quality. In looking at the concentrated Canadian equity portfolio, in comparison to the 10-year Government of Canada bond, the forward earnings yield in our portfolio, which is the inverse of the PE multiple, and also an indication of the earnings capability of the portfolio, is 7.2% higher than the 10-year Government of Canada. This equity risk premium around 7% is high compared to historical norms of 2.5% to 4% for the market. For the equity risk premium to compress, either valuations improve, hence the earnings yield falls, forward earnings fail to meet expectations, or 10-year bond rates rise, or some combination of this. On slide 13, you will find a snapshot of the sector positioning as at year-end 2018. On the right side of the slide is our absolute weight in each of the 11 S&P TSX sectors. And as seen, we have positions in 5 being the minimum, of the 11 sectors, with the largest weight being in financials at approximately 48%, with the sector maximum of 50%. Our greatest overweights, based on our upside potentials, are derived from our bottom-up value investment approach, and they are in financials and materials. This is where we see the best value. We are underweight all the other sectors and cannot currently find value to meet our high return threshold in 6 sectors: healthcare, real estate, consumer staples, IT, utilities, and communication services. As you can see, we are anything but closet indexers. On the next slide, slide 14, we will highlight a few of the largest overweight positions relative to the S&P TSX. Given the concentration of the portfolio, the active share, meaning differences from the benchmark, is 69%, with tracking error currently at 6.2, the lower end of an expected range of 6 to 8%. As you can see in the top 10 overweights, the total weights of these names are over 40% versus an index weight of just 4%. Yes, 10 times the weight, with a current weighted average upside potential of around 40%. I believe I've mentioned all these names at some point during the presentation, except for 2, the top 2 positions, both in the financial sector. Allow me to wrap up the presentation with a few bullet points on 2 of our favorite holdings, Cibc and Powerport. Cibc is the 5th largest Canadian bank, and with the 2017 acquisition of Private Bank Corp, now has a decent foothold in the US. Culture rebuild is ongoing under current CEO with a focus on relationships and cross-selling. Execution has been good and consistent. The earnings per share CAGR is around 8% over the last decade. Yet the market, for some reason, continues to penalize it for the mistakes made during the 2009 financial crisis. Last year, earnings were up 9%, yet the stock fell 13% to trade at 8.8 times forward earnings estimates. Incidentally, Cibc was not alone in this regard, as all of the big five banks experienced similar results. With the lowest P multiples in years, supported by the best balance sheets they've had in years, and a diversified and resilient revenue stream, we strongly believe the marketplace has it wrong. Powerport is a large diversified holding company controlled by the Desmarais family. Powerport owns 2/3 of Power Financial, which itself is a holding company for Great-West Life, IGM Financial, and Pargesa, and some private investments. Powercorp owns blue chip franchises in the financial sector, which are being reinvigorated with top-class management. Long-term focus and record of the family in creating value remains intact, but shorter-term cyclical issues from market volatility have presented a compelling opportunity. Powercorp trades cheap at 7.7 times earnings, 0.8 times book value, and a 50% upside to our intrinsic value. Hopefully this presentation has helped you better understand the strategy. We know your time is valuable. Thank you for listening.